Hello, potential tax-free founders. Welcome to Unlock Tax-Free Startup Equity Gains from the Tax-Free Gains team. Stephen Covey wrote about in the 7 Habits of Highly Successful People to begin with the end in mind. And in startup planning, that's called exit planning. And too often we get caught up in the day-to-day grind and we're building stuff and we have to exit plan if we're going to take advantage of the qualified small business stock, QSBS loophole. Made possible by Section 1202 of the IRS Code. So super excited to talk more about it, and we have some extensive show notes in the Notion supplied to you upon signing up. Who are we? My co-founder Tuomas is from Finland, and he's an IT professional, and he's an automation-focused co-founder on our team. And I'm the tax-focused co-founder and CEO. I run a small single-person tax practice called Less Tax US, and also really enjoy the startup focus here at TaxFree Gains. Some of the people in my network know me as an Occupy Wall Street activist, though prior to Occupy Wall Street, I obtained a master's degree in finance at City University of New York and Baruch College in New York City. And so I supplied a lot of people in my network with the ebook, which is available in the show notes, Navigate the Tax Code to Riches, which doesn't focus on 1202, just to let you know. Some of the feedback I got was, hey, who is this person? Where are you coming from? And I just want to inform people that I take the same tenacity for equality, and not equality of outcome, but equality of opportunity. And I'm here to be a startup counsel and consigliere for founders so they have equal power at the table with startup investors who usually have more power and money. So just want to let you know I take the same degree of tenacity I took to my days as an activist, and the goal is to legally minimize taxes to maximize impact. And we're all about keeping more of what you build means having more to give. And I don't know about you, but my co-founder and I both received $10,000 to move to Tulsa, Oklahoma. So we're very excited about the opportunity to prepare the new wealth of tomorrow with opportunities to give to other budding startup founders who are hungry to make a difference. Quick overview, something very simple, capital gains tax. Basically, you sell a company, it's a taxable event, and you have to pay the tax on the difference between your sale price and your basis. Typically, the basis is very low because the early stage startup stock issuance, and hopefully your sale price is very high. That's the opportunity. Just quick note, 15% is the typical long-term capital gains tax. For QSBS, you have to hold it for 5 years. And if your exit is particularly successful and it pushes your income over $518,900, including regular income and capital gains for that year, you'll be in the 20% territory. So there's a 20% gain on the table for just complying with QSBS regulations. How to make tax-free gains. QSBS, Section 1202 of the IRS Tax Code. Know it, learn it, and have the right team to help you navigate through it. 4 must-haves. You need to be a U.S.-based C corporation. Could be Delaware. It doesn't have to be. Just has to be U.S.-based. Active business operations. Under $50 million in assets when your shares are issued. Any shares issued after $50 million can still make appreciation. It's just you're going to have to pay capital gains tax on that tranche of shares. And there's a 5-year holding period, as mentioned before. Industry requirements, startups qualify. That means AI startup founders, that's you. Product companies, innovation-focused businesses. Automated services work, but services that are human-based services don't work. Financial companies don't qualify in real estate businesses, nor do motels, hotels, restaurants, things of that nature. And what's the reward? The reward is $0 in taxes up to $10 million or 10x your basis. Who qualifies? So founders qualify, early employees with original issuance stock qualify, direct investors, but they have to have original issuance stock. So it can't be Series B investors. It needs to be earlier stage in that where they were given original issuance stock. And gifts and transfers may maintain qualification as well, and we'll get into that in a moment. Timing is everything. The clock starts at share issuance. We have a slide later on simple agreements for founder equity, made famous by Y Combinator, and those aren't actual C Corp shares. So the timing, the 5-year clock doesn't start until the shares are actually issued. It applies to each share certificate. Plan ahead for exits. And the 1045 exchange is in case you were particularly successful, had a liquidation event, sold some shares before the 5-year window, you can reinvest in other tax-free startups and continue your window through the 5 years as a rollover, and you'll still get your benefit. A couple examples of savings potential. A $100,000 gain yields you $85,000 if you have to pay cap gains on it, and $100,000 yields you $100,000 if you don't have to pay cap gains. Once you get into the millions territory, you're in 20% territory, and the numbers look really nice. It's nice to save $2 million for just complying. State tax impact, we have a state tax guide clicked in the show notes, but ultimately states are complex. California is one of the worst, and they treat capital gains like regular income. At the highest bracket is 13.3%, and that's money you're going to have to pay if you reside in California, regardless of where you are incorporated. In Oklahoma, it's 4.75% for out-of-state tax. That's for out-of-state stock investments. For in-state stock investments, which you've held for at least 3 years, you end up being able to pay 0%. So Oklahoma is all about taking care of its own backyard. Delaware and Maryland each treat capital gains as regular income except QSBS. They accept QSBS exemption, and so it's 0%. So if you're incorporated in Delaware and residing in Delaware, you wouldn't pay $1. Be careful not to disqualify. Plans share buybacks when an employee leaves. Asset threshold violations, meaning grew beyond the $50 million point and you're trying to still get QSBS, you can't do that. Business model shifts when you're planning a pivot. If you pivot out of tax-free status, we need to communicate with your tax-free investors so they're clear about your path forward. And then investment portfolio issues. If you buy long-term investments and don't use 80% of your money for day-to-day operations, you disqualify. So you need QSBS advisors like Tax-Free Gains team to help you through this process and ensure you're steering your ship and navigating properly. Advanced strategies, and this is where it gets really nice. We've got a $20 million and a $40 million example with a star next to it, because I've already told you it's this $10 million cap, right? But that's a cap per taxpayer entity. So there's a way to adjust, donate shares to other taxpayer entities that you may or may not have control of, and still get maximum tax benefit. Family giving example is a really good one. Family member gets their own $10 million limit. The 5-year holding period doesn't actually reset on gift transfer. It continues from share issuance. And the example is the Roblox founder. He had a $10 million chunk for him and his wife. And for his 4 kids, he ended up having $10 million chunk for each of them. So he ended up with $50 million total tax-free gain. Rock on. Tax-free impact. You can definitely donate to a charitable remainder trust, to a charity of your choice, and lose control of the assets themselves. But if you put it in a donor advised fund, you have the opportunity for an immediate tax deduction when contributing to your DAF, and you can donate appreciated assets like avoid gaining capital gains taxes. There's tax-free growth within a DAF. But the cool thing, let's say you're a carbon-focused founder, or you're a founder who's not in the carbon space, but you have carbon competence. You want to set up some impact investment opportunities. You can deploy mission-related investments in a tax-deductible donor-advised fund and take up to a 25% ownership stake in a startup. So we're really excited about bringing tax-free impact into our ecosystem and community. Another strategy is QSBS packing. Since you can build your LLC value up to $45 million and then switch over, add around to a C Corp and get high basis QSBS stock. What about simple agreements for founder equity? Safes do not start the QSBS holding period. The clock starts only when converted to actual shares. What this means is if you read the actual language of Section 1202 of the IRS Code, it's very clear. You need to actually be in possession of stock certificates of C Corp stock that's original issuance. Safe is a promise for future equity. It's not equity itself. And everybody needs an attestation letter to prove to the IRS that your stock meets the QSBS criteria. And our team at TaxFree can help prepare that for you with our advisory service. Get pre-qualified. Be some in-depth questions about some of the materials we covered here today. And we're looking to get investors in front of pre-qualified founders at some of our investor events coming up soon. And then after that, schedule a call and we can take you to the next level as a tax-free startup. So thanks very much for listening to them, and we look forward to hearing from you soon.